Welcome back. More to talk about with your retirement. I'm very excited to bring back the author of Retirement Reboot and also Miller on the Money, and that's Mr. Dennis Miller. Dennis, welcome back.
Good to be here, David. Thank you.
Good to have you. Yes, sir. So I think for our audience, the thing that I really enjoy having you on the program is that you've walked the walk, you've talked the talk. I know that you did a lot of work for Fortune 500 companies during your career, your working career, but then you made the transition to retirement, but then you've kind of come out of retirement like a fighter. And you are guiding other people with your books and your newsletters and the things you do on what to be thinking about with their retirement. So I applaud your work, and I really enjoy reading what you're talking about, because so many people are looking at where we are in the world today, and they're saying, golly, things have never been this uncertain. How do we deal with this? And things seem to be changing so quickly. So I think you can share with the audience your perspective, because you've done what I call change the tire on the car while it's still on the track, which is hard to do. So speak to us a little bit about how things have changed and how people really need to come to grips with the reality just being different today than it was years gone by.
Well, David, you know, that's interesting you asked that, because I look back after my father's money and my mother-in-law's money. And in those days, things were different. They had a nice nest egg, and you could put it in CDs and bonds, and basically they were living off the interest, and they could enjoy life, and they didn't have to worry about it.
Yeah.
And of course, since the first bank bailout, where interest rates went right through the floor, the whole world has gone topsy-turvy when it comes to retirement money. I read something recently where it's not just the retirees and the baby boomers. It's affecting pension funds and their projections all the way down to people in their 20s now.
Absolutely. Well, and you speak to pensions, Dennis. You know, the thing that, you know, once upon a time, that age gone by, pensions were a big part of the retirement picture. You arrived at retirement with your house, and a lot of people, the American dream was to pay off the house. You had your pension, you had Social Security, and retirement was a long vacation.
Yes.
And what money you had saved also in maybe cash and savings and CDs. Like you said, Dennis, they had put that money into things where it earned enough interest and they drew less than it made, and life was good.
Yes, exactly. And, you know, even while in the private sector, pensions are pretty much a thing of the past.
Exactly.
The major corporations couldn't afford to continue to fund it and invest it, so that they were responsible for helping people get involved in 401ks. But even with a person today who's had a 401k, you know, we had a magic number, and when we reached 65, if we hit that magic number, we could go on a long vacation.
Right.
And we did that. And I was 68 years old when they came out with the first bank bailout bill, and the vacation ended because they changed the rules. And I think that people are going to have to recognize that. You know, take a look at the jobs report. You know, if you look behind the curtain, you're going to find the majority of the jobs that are being reported in the jobs report are seniors coming back into that workforce. And it's scary, because they're concerned about having enough money to last for the duration.
Well, if you think then about where people are today, and the viewers who are watching this program, they're going, okay, I'm retired, I've got my Social Security, I've got some income I'm drawing, maybe they've got their required minimum distributions they have to take from their IRAs and 401ks. They've got these funds, and they go, okay, well, I've got this, I don't know how long it's going to last, and I keep hearing that the market's at an all-time high, or markets are volatile, and there's always that risk. You know, speak to that, Dennis, because people, they just go, I'm not sure. Now, from a financial planner standpoint, I want them to build a plan, map it out, know where they're going to draw their money from. I don't want them drawing their money from money that's going up and down in the market. But people just kind of see all that and they go, gosh, I hope I'm doing the right thing.
And that's very normal. And I think that's part of understanding and coping with that, because, David, you know, there used to be what I would call sure things. 6% interest. You could always get 6%. Not a sure thing.
No.
Social Security. I don't think Social Security is a sure thing anymore. And I'll tell you why. You know, what people don't understand, while there is theoretically a Social Security trust fund, basically that's nothing more than Treasury IOUs, okay?
Right.
If you were the president, and I'm joking here, of Enron, and you had your employee pension fund and you put it all into Enron bonds, you'd go to jail.
Yeah,
Okay?
yeah.
And what's changed, and this is something you don't read about very often, is that up until 2010, the amount of money that the federal government got by taking Social Security out of people's paychecks covered the payments to retirees.
And then some.
And then some. So they just spent the rest of it on bills and put some more IOUs in the theoretical trust fund.
Right.
Okay? But in 2010, that flipped. So now, instead of having enough receipts from the workers to pay the retirees, now they're having to make up that slack. And David, I saw something, I believe it was on Heritage Foundation, by 2032, that's going to be something like $330 billion. So that means on top of the normal government borrowing that they have to do to pay all the rest of the bills, they're going to have to find a way to come up with another $332 billion to pay Social Security recipients. And you know, the politicians can continue to try to kick the can down the road, but it's not solvent. And sooner or later, probably closer to sooner, they're going to have to deal with it, and that nobody will be exempt. They're going to find means testing.
Right.
They already are talking about, there's a bill in Congress, and they've said it's going to be first talking points, of course, where they're going to change the cost of living adjustment formula and may eliminate the cost of living adjustment for high wage earners, which means middle class.
Right.
You know? And the fact is they're going to raise the retirement age. You know, I told my son who's in his 50s, he may not get his Social Security till he's 70. And then they can change the rules. It's not like an annuity with a private carrier. You know you're going to get some Social Security when you retire.
Right.
You just don't know when. You don't know how it's going to be calculated. It may not be even in relationship to your income. And they're going to change it several times between now and even after you retire. So the fundamental, one thing we could count on of Social Security, David, I've said this before and I'll continue to preach it. Your most valuable Social Security check is going to be the first one you get.
I don't disagree.
Well, you take away the cost of living adjustment, it's going to buy less and less and less. So now let's talk about all this other stuff that you talked about. Where are you going to make up the slack?
Exactly.
I don't want to be in long-term bonds today. They start raising interest rates, and you're either going to have a below-market interest rate or your capital is going to go down. The stock market's at an all-time high. I'd have a real hard time, David, putting a whole lot of money into the stock market with a PE ratio where it is. So the retirees today, regardless of whether you're 80 or whether you're 40 thinking about it, are going to have to find a way to supplement their Social Security safely. And that's the challenge, because no matter what plan you put together, it's got to be flexible. And
well, all plans are carved in Jell-O because they have to
Great
be.
line.
Yeah, they have to be carved in Jell-O because so much of this can change. And I agree with you, Dennis. I think Social Security, people, what they're going to receive, it's going to change. Now, I think politically, you're right, they're going to kick that can down the road as much as they can. And for people who are already retired, most likely going to receive some sort of Social Security. It may not be as much of an increase, and it may become at some point needs-based or income-based, or that's all political speak for if you make a lot of money, you may not get as much as the other person. But I think you've hit a real key point, Dennis, and that is that there's going to be changes, so you better be ready to adapt, whether the market's high, the market's low, somewhere in between. You want to have a diversified portfolio that brings things in together. You're not all tied to, you know, the S&P 500. You've heard people say, well, golly, if I'm going to hire somebody to manage my money or I'm going to have to pay fees, I'll just put my money in the S&P 500 and I'm done. Well, you know, that's all well and good, but then when the market drops 40%.
Worse than that, David. I've had somebody sit down and say that to me, and their attitude is, the S&P 500 always comes back. And the answer is, as a retiree, can you guarantee me it's going to come back in my lifetime?
That's the key question. Because it may not.
It may not. I mean, go back to, you know, what was it, 25 years after the Great Depression. And that's the point. Maybe the S&P is going to come back, but you can't guarantee me it's going to happen in my lifetime.
You better not be counting on it for your income. And I think that's where people get tripped up. And again, it's because they're used to this traditional approach that you talked about, Dennis, where we put the money in, we're going to make 6% or so, I'll draw 4, everything's hunky-dory, it's all good. But that's not realistic today. You can't be drawing the money you're living on from money invested in the market and expect to avoid or remain unscathed by a market drop.
David, I'll tell you how bad it is. A lot of publicity about the California pensions, CalPERS, and I read an article recently where they're now $19 billion underfunded. And that was based on changing their projections to like down to 7.2% and down a little bit further.
Right.
But then the pension consultant said, realistically, they have a 75% probability that they cannot achieve those goals 7 years in a row, which means you got a 25% shot at it. And David, with all the horsepower, all the PhDs, all the computing power, all the analysts, if they can't do that, how's the average person, even working with someone like yourself, going to have a shot at having that kind of probability? The one advantage we have is that we can change on a dime. We're not trying to unload, $4 billion worth of company stock.
That'd be a good problem to have, though.
Yeah, yeah. But the fact remains is that if they can't do it, I think the real message for retirees today is you better stay on top of it. You can't abdicate it to somebody else. And you're going to, whether you like it or not, have to actively manage your money until you die.
And think about it differently. Think about drawing from your principal and having to take interest and income or part of the principal and try to rebuild back by investing longer term some of your money.
David, there's no way I can explain it. But when I retired, I could live off the interest and never have to touch the principal. I played by the rules, all the numbers worked out. Now I'm finding a lot of my peer group are finding that they're having to eat into that.
Right.
And it's something that people can't understand until they've been there. I could sit down, David, and you could show me, Dennis, here's your money. If you do this, if you do that, unless you live to be 122, you got plenty of money to last you the rest of your life. And David, I don't care how many times you tell me that, I still have a knot in the pit of my stomach. Right. What if this happens? What if that happens? That is, you have enough to last you 122. Then again, if something else doesn't change.
Right.
Like healthcare costs, like means testing Social Security,
all of those things.
Or something we haven't even thought of.
So
and that's scary.
Monitor, remain nimble, know what you have, don't abdicate responsibility, stay involved, ask questions if you're not sure about what's happening with your portfolio. And please, probably biggest of all, the big one for me is that don't build your financial plan on rosy assumptions. Once upon a time, financial plans were built on, hey, we always make 12% average return. Well, I think after 2000 through 2002, a nearly 50% drop in the market, and then a 40% drop in 2008. I think people learned that lesson. Most people did, but there are still financial people that talk about, well, we can get you 12% a year. It's not realistic.
It's not realistic, and the sad part is, and you and I have talked about the difference in the planning level, where you have to look at it differently than, say, somebody who's working for a major brokerage firm with the suitability versus a fiduciary. And that I'm still seeing things in brokerage houses where they say, look, it's always average this, just put it in there, it's going to average it for the next 15 years. And that's what they've been trained to say. And they're young enough that they haven't experienced the fact that maybe that's historically the way that's worked, but this world is different today.
Yeah, that's
and
true.
You talked about the political side of Social Security. I don't care whether it's Democrat or Republican, Libertarian or whatever, their politicians are going to continue to kick the can down the road, hoping that somebody from the other political party tries to fix it so they can take the blame. And who knows what it's going to turn out like.
Yeah, that's
true. And it's scary because we're counting on that money for the rest of our lives.
All right, well, we're going to make sure you get your Social Security, Dennis.
Yeah.
The thing that I want to leave our listeners with our discussion today, Dennis, is that the reality is that these things are going to change, and we know they will. So be willing to adapt, be willing to get a fresh perspective. I tell people all the time, if you're not sure, get a second opinion. Get somebody to step back from this and look at it. And a lot of times for do-it-yourselfers, they really can't see the forest for the trees. They're so close. They're studying the bark of the tree, Dennis.
Yeah.
They can't see what's really happening without stepping back and maybe getting that opinion.
I think there's another side to that, David, too, and that is you still want to enjoy retirement.
Sure.
To me, a healthy retirement is being able to enjoy life without having to constantly worry about money. One thing that I've learned since I've been retired is that when you understand the big picture, yeah, we know we're going down the road and there may be some twists and turns in the road. But the reality is, once you're comfortable with that, you can live with it so that you're not constantly worrying about money. You kind of feel comfortable that you're going to be okay as long as you keep on the track you're on. And I think that's important too, is a good plan helps you enjoy retirement.
Just carve it in jello.
Yeah, right, for sure.
Dennis, thanks for being with me today. Very
Thank you, David.
insightful as always.
Thank you.
If you would like more information about the topics and our guests featured in this series, please visit our website at PlanStrongerTV.com. Also, if you have a question you would like David to answer, please send it to questions@PlanStrongerTV.com.